Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Uncover the Power of Risk-Adjusted Returns. When it comes to investing, understanding risk-adjusted returns is crucial. Not only do investors seek high returns, but they also need to assess the level of risk associated with those returns. This balance is what risk-adjusted returns are all about. Investors need to consider risk alongside returns to make informed decisions that align with their financial goals. By evaluating risk-adjusted returns, investors can weigh the potential rewards against the risks involved, helping them make more strategic investment choices. Key metrics used to evaluate risk-adjusted returns include the Sharpe ratio, which measures risk-adjusted performance by considering the volatility of returns, and the Sortino ratio, which focuses on downside risk. These metrics provide valuable insights into how well an investment performs relative to the risk taken on. Understanding risk-adjusted returns. Investing in the financial markets involves various types of risks that investors need to consider to make informed decisions. These risks can significantly impact investment performance. Market risk, credit risk, and liquidity risk are three main types of risks commonly faced by investors. Risk in investment. Market risk. Market risk, also known as systematic risk, refers to the potential for investments to be affected by broad economic factors such as political events, interest rate changes, and market volatility. For example, a stock investment may decline in value due to an economic recession impacting the overall market. Credit risk. Credit risk is the risk of default by a borrower or counterparty, leading to a loss for the investor. For instance, investing in corporate bonds carries credit risk, where the issuing company may fail to meet its debt obligations, resulting in financial losses for bondholders. Liquidity risk. Liquidity risk pertains to the ease of buying or selling an investment without causing a significant impact on its price. Investments with low liquidity may lead to challenges in exiting positions quickly, especially during volatile market conditions. Return on investment. Returns on investment measure the profitability of an investment over a specific period. Commonly used metrics to evaluate returns include return on investment, ROI, and annualized return. When assessing investment opportunities, it's essential to consider both returns and risks. The relationship between risk and return is crucial in determining the potential gains against the level of risk exposure. By understanding the different types of risks and how they can affect investments, investors can make more informed decisions when analyzing potential returns. Assessing risk-adjusted returns helps investors compare various investment opportunities on an equal footing by factoring in the level of risk taken to achieve the returns. This metric plays a vital role in evaluating investment performance and determining the efficiency of a given investment strategy. Key metrics for evaluating risk-adjusted returns. Understanding key metrics for evaluating risk-adjusted returns is crucial for investors seeking to make informed decisions. Let's dive into three commonly used metrics: the Sharpe ratio, Sortino ratio, and Trainer ratio, which provide valuable insights into risk and return relationships. Sharpe ratio. The Sharpe ratio is a widely recognized metric that measures the risk-adjusted return of an investment. It is calculated by subtracting the risk-free rate of return from the investment's return and dividing the result by the investment standard deviation. A higher Sharpe ratio indicates a better risk-adjusted performance, as it shows the excess return generated per unit of risk taken. For investors, a higher Sharpe ratio implies a more efficient use of risk to achieve returns. Sortino ratio. The Sortino ratio, an alternative to the Sharpe ratio, focuses on the downside risk of an investment. It is calculated similarly but considers only the downside deviation, which helps in assessing the risk associated with negative returns. Some investors prefer the Sortino ratio over the Sharpe ratio as it provides a more specific view of risk by emphasizing downside volatility. In scenarios where minimizing downside risk is critical, the Sortino ratio offers better insights for risk-adjusted returns evaluation. Trainer ratio. The Trainer ratio evaluates the excess return of an investment in relation to its systematic risk, measured by beta. By dividing the excess return over the risk-free rate by the investment's beta, this metric helps investors understand how well a portfolio has performed relative to the systematic risk it has taken on. The Trainer ratio is particularly useful in assessing portfolio performance within a systematic risk framework, providing a quantitative measure of how a portfolio manager has utilized market risk to achieve returns. Understanding and utilizing these key metrics provide investors with valuable tools to evaluate risk-adjusted returns effectively. By considering the Sharpe ratio, Sortino ratio, and Trainer ratio in tandem, investors can gain a comprehensive perspective on risk and return dynamics, enabling more informed investment decisions in today's complex financial landscape. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.